Hello there, Happy New Year. This is the final video of this course, on-demand course, Fit 21. So let's get started. I suspect there'll be a lot of things that we want to cover today, and it's going to go a little bit longer than my liking, but this is the final video. Hang in there. This is a code that I really like. It's basically about putting a little effort that's going to give you bang in the long term, right? So the winner of the trading game would be announced on Hoppy by next week. So we still have a week left officially. And there's going to be a final assignment, right? That would be announced on Hoppy as well. I think we all know why we need to invest, right? So I'll just go to the basic idea that cash is such a bad thing. And if you look at the interest rates, because the kind of world that we've kind of evolved into, the economy that we've evolved into, what I mean by that is there was a time in the past, and you can see that in this chart, the light red color is the interest rate, right? It's the base interest rate. And that used to be like 14%. If you 15%, right? In the 82, if you look at 82, it's like right up there. And it's gone down globally. The interest rates have gone down to near zero, or in some cases like Sweden, it's negative. Even in Japan, it was negative for a while. So keeping your money in a bank account in that case is basically eroding, right? And once you adjust it for the inflation, that means you are losing a lot of that cash that you think you hold. And that's why investment is a no-brainer in the world. And this idea that index funds, a lot of people are switched onto it, and that's a good place to start. I definitely agree and recommend that. The only caveat, and the reason is very clear, right? They tend to just go up. We've seen that the market performance over long term is going to be positive anyway. So you've got some dips that you can see. You can see dip in the 2000, the tech bubble burst, and then there is a dip after the Great Recession in 2008, 2009. That apart, in the recent crisis, what we call crisis, you don't really see that dip. In fact, it's gone crazier. So whatever level that you see here, it's actually not depicting what happened after the corona has hit our shores. And the reason for that is very clear. It's not a financial crisis, a health crisis, and all that thing. So there are pros and cons of going after ETFs. Nothing against, but you have to know what works for you, because there is going to be cost involved with it, because there is a fee that needs to be paid. So you have to figure out whether it's actually making sense for you, but why not? The only problem that I have with these funds is they are top heavy, which means there are a few stocks that are almost that are 25-30% weight. Right now it's gone up actually, because Tesla has come in and it looks really top heavy, and that is an issue. Clearly that's an issue, because they are, as you can see here, I mean, it's not really representing that 25% weight. It looks like half, but what it means is they are presumably in one sector. We can call it tech, or I don't know. I mean, I have a problem with that tech sector, but that's like a simple sort of group cohort of stocks that we like to define as. And the problem is they all are highly correlated. What it means is they all go down and they go up more or less together, right? So if there is a big correction that is supposed to come at any point, we don't know. Obviously, nobody knows. In that case, you will take a huge hit, and then you should have this ability to sustain it for for a long time. Again, it comes with that. You have to make it clear that historically we used to have those corrections, and those corrections would have an impact for half a year, 2 years before things come back to normal. But the world has changed dramatically. So I would not really be betting that, these corrections would continue a downward trajectory, but there'll be a correction back, there'll be a pullback, and then they'll go up again. So that's a possibility, real possibility. But one of the thing that we all deal with is we want to time the market, which means we want to enter a trade when it's cheap. And how easy or feasible, or how even is it really needed? And the answer to that lies in one of the quote that I really love from one of my favorite investor, Peter Lynch. And he says that in the long term, it doesn't really matter, right? If you are investing for 5, 6, 7 years, and I would just qualify his statement. He's talking about a few years earlier, where 10, 20 years was, something given. But the companies, the way they are becoming chameleons, the way they are changing their fundamental business, I think this is a little bit too long-term. But certainly we can see there are monopolistic tendencies in some companies, and those companies will dominate in the future. You can actually bet, so what you see here, these companies would have a really good hold on the future, clearly. But because there is so much demand for these stocks, so what you actually notice is they are overpriced, right? By all the traditional metrics, these companies are super overpriced. But what I'm comparing them with, I'm comparing the historical prices, maybe with the revenue and the profit and the stock price, right? If you have that kind of a correlation, this correlation is getting weakened. And a lot of people are saying we live in a different world. I am not really sure. I want to be cautious because we've seen that before. We've seen when the tulip bulbs were selling in Netherlands and people were going crazy, right? So those bubbles, they do exist, and they could be a correction. We would come back to the ground, looking at the basic fundamentals of the companies, which we have sort of taken our eyes off for the moment. The other thing that people often talk about is, take from a successful person, you copy their investment philosophy. And I have no problem with that, but in order to do that, you have to figure out what their strategy is out of it, right? You need to know it completely. And that is often not the case. If you're reading a book by Warren Buffett and you say, okay, this is the strategy I'm going to use in my investment, the problem with that is he's Warren Buffett. He obviously has a much greater sway on the market. He has the pulse. He has got a little bit extra information. I'm not saying he's doing any kind of insider trade, but he has understanding of other factors. He has connection with those people, like the government officials, the new policy changes that's going to come, and he can envision that this is how it's going to play out. Can somebody like us play that game? I doubt that, but yeah, I mean, there are people who are trying and there are people who are successful. So any strategy could work, really, because there is so much plays out in tandem with you as a person and the strategy that you choose. That we've talked about that. Now, some of the trading mistakes that I want to put here. Overall, we want to talk about investment because that's what I gather is what you are interested in. So these are some of the mistakes that I often find. I have seen myself going through it. So you start your trading, not having a trading plan is a bad idea, which means knowing exactly when you want to enter and when you want to exit, right? I've talked about paper trading. I can't emphasize it enough, right? You need to do that for 6 months, a year, without using your money, and then you understand, you figure out your mistakes, you become disciplined, you learn to curb your instincts, right? Overtrading is one of the massive problem with anybody who has set foot on the trading, the world of trading. What it means is once you get a little bit of profit, you go all out. Overtrading also means you have a loss, and then you go all the way to recoup that loss, right? And that's what is called revenge trading, because you want to get back your money by hook or crook. And by that, so it's a very gambling tendency, which is not bad, but I'm saying not having that discipline. I mean, if you don't know how to do that, I think it ends up not well. The fourth is the quickly scaling up. You made $1,000 in one day, and then you go out and you're putting, let's say, $500. You got $1,000, and you go crazy. You say, okay, I'm going to put $10,000 the next week, and that's scaling up too much, because the risks also compounds the way you put in your money, right? Your input compounds your risks. So that is a bad choice. So you have to, that's where the discipline comes into. And fifth is, I think I have said it earlier, there are no experts. You don't want to follow any YouTube video suggesting these are the stocks to buy. There are plenty of those people. You want to stay away from them. You want to see how they're analyzing those stocks, nothing wrong with it. And I am not really sure, if you don't understand how that analysis needs to be done, you can actually, validate, or you can say that these guys are legit. You won't know that. And that's why I say, this is something slippery slope. Yeah. Then talking about the kind of stocks that you want for investment. Now we talk about investment. Value stocks are stocks that are undervalued right now. The price, that what it means is it has a high value, but the price is not reflecting that value. So you go after that, right? These are cheap stocks, what we call. Growth stocks, on the other hand, has their performance at the moment could be stellar, but also that this company or this business is going to grow in the future for medium term at least, right? And so you can choose one or the other. Value stocks are also the ones that give you dividends. We didn't really talk much about dividends, but that's one Pandora's box that would take a course on its own, right? And dividends are much more stable stream of incomes that you get as an investor than the capital gains. Capital gains, you would be betting on the growth stocks to get your capital gains. What is capital gains? Your buy price is lower than your sell price. But all the gains that you make in the world of investment, and we've not covered this in course, which is a really important part, is the taxation, right? Understanding how you will get taxed and how you can reduce that tax burden. I'm not saying don't pay taxes, but I'm saying, yes, there are clever ways to structure your investment, and that allows you not to, lose a lot of that gains in the form of taxes, right? So some of the checklist I put up here. You want to invest long term. You want to make sure that it's a solid company that's not going to disappear anywhere. So the companies die because of debt, right? Debt is the only thing that kills them. So if they have low level of long-term debt, then you are sure you are fine with that company. So Facebook is one example I gave. Facebook has no long-term debt, but I'm not saying I'm not recommending, by the way, right? In this course, I don't recommend any stocks. The other thing is, if the company has predictable cash flows, those are the companies that are loved by the market. And you can see Microsoft and Adobe's performance in the recent time. It's based on that predictable cash flows, because they've got this recurring revenue model, which is subscription, right? They've converted software as services into a subscription model, and they are pioneer. I wouldn't say they are pioneer, but they have basically been at the vanguard. They've been the most successful companies that are able to do that. Then earnings potentials, it's a no-brainer. Second point is about the profit, how much profit this company can earn in the future, not today. It's not about today. It's not about, you can extrapolate based on what they've done in the past, but yeah, it's an important part, because I've said it earlier, earnings or the profits are the only thing that is directly correlated with the stock price, right? Then the third point is growth drivers. So if you know early on, this company is putting a lot of money in the R&D, research and development, and they have got a different sort of tack on what's coming. They are going into a new market that doesn't exist, right? So those are the growth drivers you can, if you can analyze, and that's where comes your understanding of that business, right? So reading about that business, understanding that business inside out is one of the ways to basically with, be aligned with the 3 bullet points that are there. And the final one is where I start my investment all the time is the people, the quality of managers, investors, board, and also making sure there are no running conflict of interest is extremely important. So this is like my sort of simple, and then high conviction stocks. High conviction stocks are the stocks that allow you that gives you are totally sure of these stocks, right? So they have stability, they've got growth, they are monopolies, people know them. The being familiar is great because then there will always be demand for that stock. Then the future, and that's where your sort of qualitative understanding of the company comes into play. Your story, you build a story, and then the governance of that company, right? Would there be some kind of conflict that would destroy the value for that company? So, and I always do in investment, I love to take risks. So every time the market collapses, that's when I just put everything into the market. And I think I've learned. My first big experience was 2008 crisis. I have whatever money I had, I put that in the market, and people were saying the market would disappear. There was this think about that financial markets won't exist tomorrow the way it was spooky, but on a daily basis. That's when I told you earlier, that's when I started my day trading, but I put almost everything that I had back then, and the returns were obviously, you would imagine, there was so much fear. So when the fear is there, that's the time to, but you really want to, I would not recommend you do what I did. That was a tad bit not sensible or not responsible, but that's what you do, right? There are moments when you do that, right? But again, understanding, so market pullback means the entire market collapses, right? And there are good bets and there are bad bets. So understanding when this psychology hits the market, the bad sentiments hit the market, you want to figure out there are companies whose growth story has not changed. It's just the overall correction, and you want to bet. So you get easy picks with that, right? So the underlying principle is go after stocks that are damaged, not the companies, right? That's the thing I live by, really. So that's where the fundamental analysis comes into play. You analyze the company inside out, and you do well. It goes without saying if you can predict what's coming next, right? Which are the businesses that are on the cusp of disruption? If you can figure that out, you are home, certainly. But with the new industries come new responsibilities, as Spider-Man uncle would say, right? So the matrix that we've used traditionally, if you are looking at a new or emerging or a futuristic business, those metrics will not work on this new industry. And that's where understanding new metrics, and I always say you have to know that business. You have to understand that business really well. You have to understand all sorts of connections with the economy and the people's psyche vis-a-vis that. So if you can figure out these things, then those investments are great. Let me just summarize what we talked about in this course. You have to buy what you understand. You don't want to know, if you don't know what metaverse is, don't go there, really. Or if you don't know how the superconductors or the chips business work, you can hang on for a while, but in the long term, you would not be able to pick that, what I call, or what Peter Lynch called 10 beggars, those whose value goes 10 times up over a period of time. And that's why research is extremely important to understand. So you would not know everything, obviously, to begin with, but with research, you get that insight. And so once you're committed to a stock, once you have a high conviction stock, you don't want to give in. You want to forget what market is doing currently with that stock. You don't want to be swayed by that. That is an important thing. And being contrarian where you are not following the conventional wisdom is really important. You buy something that you think has a value, not what everybody else feels. So there are some of the tick boxes based on the corporate governance, where the people would come in, and then also the numbers, the accounting numbers, right? Some of the numbers that are important, I put in this slide. There's some reading list that I would recommend if you want to go this lane. These are 6 books that I would highly recommend. You can't be without them. And these books have been around. Some of those books have been around for a while, but these are classics, 6 books. Spend your time, especially the top 2 ones. You would, 3, I would say, yeah, Peter Lynch, all the way up to, you would think very differently about investment. So a book from 1949, can you imagine, right? It's so profound, this book. It has changed so many lives. So I would recommend these books. And then if you are in day trading, these are some of the books that I've enjoyed reading. I would not really say, because this market shifts so quickly. A lot of these books would not fully be updated, but these are. And finally, I would say, yes, you have to understand accounting if you want to go that path. So Warren Buffett's daughter-in-law wrote this book. It's a simple book. I would not say I like it, but it's very easy to consume. It's very easy to understand. So this is where we end this course. I said it earlier, I really don't like this format, and I'm very new to it. So yes, there have been a lot of struggles, but I think I've figured out how to quickly run these, churn out these videos. I hope they were useful, but if they were not, yeah, that's where we are missing, right? We are missing that interaction part, which I really, really like. Anyway, have a safe time for the remaining semesters that you have in this university, and I wish you all the very best. Adios.